Imagine it is 6:14 on a Tuesday morning. About halfway ED. You are halfway through your first cup of coffee when your car makes a sound you have never heard before. About 5 minutes later, a mechanic is talking about a repair that could cost $1,800. The strange part is that the repair itself is not what determines whether your day becomes stressful. Your savings account does. Well, for someone living with $400 in checking and a credit card, already carrying a balance, that repair can trigger an entire chain reaction. The rent is still due. Groceries still have to be bought. Insurance still drafts automatically. Maybe the repair goes on a credit card, which means next month starts with another payment before the paycheck even arrives. One unexpected Tuesday can quietly follow you for the rest of the year. But this is why people misunderstand the first $10,000. Assume it matters because $10,000 is a lot of money. It can buy furniture, fund a vacation, or cover part of a down payment. But the biggest change has almost nothing to do with what $10,000 allows you to buy. A real change is what you no longer have to fear every time life sends you a bill you did not schedule. This says if you like calm financial conversations built around real-life decisions instead of hype and get-rich-quick promises, subscribe to the channel. Change it happens quietly, because the deeper you look at this number, the more you realize that the first $10,000 can change far more than the balance displayed on your banking app. $10,000. Think of $10,000 as the point where money begins changing from something you constantly chase into something that starts protecting your choices. Below that level, especially when savings are close to zero, your paycheck has one primary job. Keep everything running until the next paycheck arrives. Once you build a meaningful cushion, money begins performing a second job. It starts buying you time. And time changes financial decisions. If your employer suddenly cuts your hours, savings may give you several weeks to look for something better instead of accepting the first available job. If your laptop dies, you can replace the tool you use for work without financing it for 2 years. If you need to move, take a certification, handle a deductible, or travel home for a family emergency, you have room to respond instead of immediately reaching for debt. The first $10,000 does not make you wealthy, but it makes you harder to corner. That distinction matters because financial progress is not only about increasing the amount you own. It is also about reducing the number of situations where fear, urgency, or desperation gets to make the decision for you. Consider Marcus, a 31-year-old operations supervisor outside Dallas earning about $68,000 a year. His income looks respectable on paper. After $1,650 in rent, a $420 car payment, insurance, utilities, groceries, student loans, and normal weekend spending, there is rarely much left. For years, his savings account moved between $500 and $2,000 depending on what happened that month. Marcus was not irresponsible. He contributed enough to his workplace retirement plan to get the employer match. He cooked several nights a week. He drove a 5-year-old car instead of buying something flashy. Every few months, something arrived that erased his progress. A dental bill, new tires, a flight home for a family event, an annual insurance charge he had forgotten about. Saving felt less like building wealth and more like repeatedly rebuilding the same wall. Then Marcus received a raise. After taxes, he had roughly $350 more coming into his household each month. His first instinct was completely reasonable. Upgrade the apartment when his lease ended. For about $300 more a month, he could get a newer place with better appliances, a small office, covered parking, and a shorter drive to work. He could afford the payment. But for the first time, Marcus asked a different question. What happens if I keep living exactly where I am and use that raise to finally build $10,000? Upgrading the apartment would not have been a reckless decision. Marcus worked hard, his salary had increased, and the new place would have made everyday life more comfortable. That is exactly why lifestyle inflation is so difficult to notice. It rarely feels like waste. It usually feels like a reasonable reward for finally earning more. But Marcus noticed something he had ignored before. The extra $300 was not really a one-time upgrade. It was a new permanent claim on every future paycheck. Once he signed the lease, that raise would effectively disappear. And if something went wrong 6 months later, the nicer kitchen would not help him cover a medical deductible or survive a temporary loss of income. Most people looking at this decision see one number first, an extra $300 per month. Compared with a $68,000 salary, it does not sound enormous. Marcus could technically afford it. The rent would still get paid, the lights would stay on, and there would probably still be enough money left for dinner on Friday night. But affordability and resilience are not the same thing. A monthly payment can fit inside your budget while quietly making your financial life more fragile. The more of your income that becomes permanent committed to rent, car payments, subscriptions, loans, and other fixed expenses, the less room you have when reality refuses to follow the budget you created on Sunday night. Overlooked cost was not simply $300. It was what that $300 could have become if Marcus kept it available. Emergency savings. A future car repair paid in cash. Several months of groceries during unemployment. The ability to leave a toxic job without wondering whether rent would bounce before the next paycheck arrived. Every recurring expense competes with those future options. So Marcus stayed in the older apartment and automatically transferred $350 from every monthly raise into a separate savings account. He also redirected part of a tax refund and 2 smaller work bonuses instead of letting them disappear into random purchases. About 20 months later, the account crossed $10,000. Nothing dramatic happened that morning. Find he still drove the same car. I still went to work. But financially, his life was no longer built on exactly one paycheck arriving on time. 3 months later, his company announced a restructuring. Marcus kept his job, but several coworkers did not. Well, Before building savings, an announcement like that would have sent him home calculating how many weeks he could survive on credit cards. This time, he opened his banking app, looked at the balance, and realized something unfamiliar. If the worst happened, he had time. It was the first lesson of the $10,000 milestone. The number itself is less important than the distance it creates between a problem and a crisis. Without savings, an expensive surprise can immediately become debt. With a real cushion, the exact same surprise can remain what it was supposed to be: temporary. That raises an important question. How much protection does $10,000 actually buy? Without the changes, If you want a simple way to calculate your own financial breathing room, comment stop below and check the pinned comment. I'll leave the free checklist there so you can estimate your essential monthly expenses, identify the biggest risks to your cash flow, and see what your emergency fund is really protecting. Start with the part people often get wrong. $10,000 is not a magical universal emergency fund number. For someone whose essential expenses are $2,500 a month, it represents roughly 4 months of basic breathing room. For someone supporting a family with essential expenses closer to $5,000 a month, the same balance may cover only 2. The power of the milestone comes from what it represents relative to your life, not from 5 digits appearing on a screen. This is where the number becomes useful. $10,000 can absorb many of the financial shocks that normally force people into expensive decisions. A $1,200 transmission repair is frustrating, but it does not have to become a credit card balance. A $900 dental bill is painful, but it does not have to follow you for the next 18 months with interest attached. Savings cannot stop bad things from happening. It can stop some bad things from becoming long-term financial problems. Job loss is where the difference becomes even clearer. Imagine your essential expenses are $3,000 a month. The $10,000 does not mean you can ignore unemployment indefinitely, but it can give you a little more than 3 months before other resources are considered. The 3 months may be the difference between carefully searching for the right job and accepting a terrible offer in the first week because next month's rent is already terrifying you. The healthcare creates the same kind of pressure. Even with insurance, deductibles, prescriptions, dental work, vision expenses, and time away from work can arrive without warning. The dangerous part is often not one enormous medical catastrophe. It's a cluster of smaller expenses appearing at exactly the wrong time. When you have cash available, you can deal with the bill itself instead of simultaneously dealing with the bill, new debt, interest, and the anxiety of figuring out which other payment has to be delayed. Then there is the car. But millions of Americans depend on one to get to work, pick up children, buy groceries, and handle ordinary life. When that car fails, the financial decision often has to be made quickly. Someone with no savings may finance a repair, borrow from family, miss work, or replace the vehicle under pressure. Someone with a cash cushion has something far more valuable than convenience: the ability to slow the decision down. And slowing decisions down can save money. Desperation is expensive. When you must solve a problem today, you have less power to compare prices, negotiate, wait for another option, or simply say no. This is why emergency savings can create bank returns that never appear on an investment statement. Sometimes the return is the interest you never pay, the bad deal you never sign, or the financial mistake you never have to make. There is another side to the first $10,000. Once emergencies stop consuming every available dollar, opportunities begin to look different. A $700 professional course might once have felt impossible. A trip to interview for a better job might have been too risky. Replacing an unreliable laptop used for freelance work might have required financing. Cash of fear. The cash reserves do not mean every opportunity is worth pursuing, but they allow you to evaluate opportunities based on their potential value instead of rejecting them automatically because you cannot survive the upfront cost. This is also where investing starts to feel psychologically different. JC. When your entire financial life depends on a few $100s in checking, sending money into a retirement account can feel almost irresponsible because that money is harder to reach. But once you have a real emergency cushion, long-term investing can stay long-term. You are less likely to look at your 401k or brokerage account as the emergency fund you might need next month. That separation matters because wealth building works better when different dollars have different jobs. A checking account handles normal spending. Your emergency fund protects against disruption. Retirement accounts are allowed to sit through market volatility. Money for a future home, car, or major purchase can have its own timeline. Without those boundaries, every financial goal competes inside the same pile of cash, and one unexpected expense can erase years of progress elsewhere. Marcus began noticing this after reaching his goal. His change was not that he suddenly spent more. It was that he stopped mentally spending the same dollar 5 different ways. Emergency fund was no longer vacation money, investment money, car money, and backup rent money at the same time. It had one job: protect the rest of his financial life. And because that job was covered, everything else became easier to plan. But if the math is this straightforward, why do so many smart people struggle to build even a modest cushion? The answer is not simply laziness or lack of discipline. Saving money asks your brain to give up something visible today in exchange for protection against a future problem that may never happen. And that brings us to the part of money that spreadsheets cannot fully explain: how fear, scarcity, status, and short-term comfort quietly shape financial behavior. Scarcity changes the way people think. When there is barely enough money to make it through the month, the brain naturally focuses on whatever problem is closest. Overdue bill matters more than retirement 20 years from now. But the car repair matters more than building an emergency fund. A $60 purchase that makes a difficult week feel easier can seem more important than putting that same $60 into savings. In survival mode, the future keeps losing to today. Loss aversion makes the problem even more complicated. Once someone finally saves $1,000 or $2,000, spending any of it can feel like moving backward, even when the expense is legitimate. Other people experience the opposite problem. They avoid saving because watching money leave their checking account feels like an immediate loss, while the future security feels abstract. Either way, the brain reacts more strongly to what appears to be disappearing right now than to what might protect us later. And then, social comparison enters the picture. Marcus watches a coworker lease a new SUV. A friend moves into a larger apartment. Someone on Instagram posts photos from a resort in Mexico. Somebody posts a screenshot celebrating 6 months of emergency expenses sitting quietly in a savings account. Financial stability is almost invisible, while consumption is extremely visible. That makes spending feel like progress and saving feel strangely uneventful. There is also decision fatigue. Pay the credit card first or build savings. Keep more cash or increase the 401n. Cancel subscriptions or reduce dining out. Save $200 or $500 a month. When every personal finance article offers a different answer, complexity can become an excuse to delay everything. Doing nothing starts to feel safer than choosing the wrong strategy. Doing nothing is still a decision. If Marcus had simply allowed his raise to blend into normal spending, there probably would not have been one dramatic mistake to point at. The money would have disappeared quietly through a nicer apartment, more takeout, upgraded subscriptions, and purchases that became normal within a few months. 2 years later, his income would be higher, but his financial vulnerability might look almost exactly the same. That is why building the first $10,000 is partly a financial challenge and partly an identity challenge. You are learning to tolerate the strange feeling of having money available without immediately assigning it to consumption. You are learning that a higher bank balance does not mean there is money to burn. It means there is distance between you and desperation. Think of your financial life like a suspension bridge. Paycheck is the roadway carrying everything across: rent, groceries, insurance, debt payments, retirement contributions, and the ordinary expenses of being alive. When everything goes perfectly, even a fragile bridge can appear completely functional. Not a problem appears when the wind starts. A surprise medical bill hits from one direction. A car repair hits from another. Then your employer cuts overtime for 2 months. None of these events may be catastrophic alone, but without financial reserves, every new shock puts more pressure on the same structure. Eventually, something has to give, and that usually means debt, missed payments, or abandoning another financial goal. Our first meaningful cash reserve works like adding strength to that bridge. It does not remove the storms. Marcus can still lose his job. His car can still break. Rent can still increase. But those events no longer have the same power to force an immediate financial response. The structure can move without collapsing. And over 10 or 20 years, that resilience can matter more than it seems. Avoiding just a few periods of high-interest debt, keeping retirement money invested during emergencies, and having enough time to make better career decisions can change the direction of an entire financial life. Savings are not valuable because nothing bad happens. They are valuable because when something does happen, you have a better chance of staying on the bridge. That is the quiet power of $10,000. It is not a fortress that makes you untouchable. It is structural strength. Enough room for life to shake without every unexpected expense turning into a financial emergency. If you want to build that breathing room for yourself, comment cash flow below and check the pinned comment. I'll leave the free checklist there so you can calculate your essential expenses, find the biggest pressure points in your budget, and start building a savings target that actually fits your life. Start by opening your last 90 days of checking and credit card statements. Do not estimate from memory. Write down what actually left your accounts, then separate essential expenses from everything else. Housing, utilities, basic groceries, insurance, transportation, minimum debt payments, and necessary health care belong in one category. This gives you the number that matters most. What it costs to keep your life functioning for 1 month. Next, identify 2 or 3 places where improving cash flow would make the biggest difference. It is a car payment consuming $650 every month. Maybe it is high-interest credit card debt. In all, maybe 5 different subscriptions, frequent delivery orders, and convenient spending are quietly absorbing $300 a month. Do not try to optimize 40 tiny expenses. Find the few decisions with enough weight to actually move the numbers. Then remove willpower from the process. Marcus did not wake up every payday and debate whether he felt disciplined enough to save. A transfer happened automatically. You can do the same by moving money into a separate savings account immediately after payday, then increasing the amount whenever you receive a raise, pay off a debt, or eliminate a recurring expense. Make saving the default before your lifestyle gets a chance to claim the money. And use one simple rule whenever your income increases. Before upgrading your lifestyle, buy yourself more financial distance first. That might mean your first $1,000, then. That might mean your essential expenses, then several months based on your job stability, family responsibilities, insurance coverage, and personal risk. $10,000 can be a powerful milestone, but your real target should come from the life you actually need to protect. Because the deepest benefit of saving $10,000 is not the ability to pay a surprise bill. It is the ability to make important decisions without a financial emergency standing behind you with a stopwatch. You can negotiate differently, leave differently, invest differently, recover differently. Money becomes more than purchasing power. It becomes decision-making power. So if you are working toward your first $10,000, do not ask only, how quickly can I reach the number? Ask something more useful. What would become less frightening if I had this money? Maybe it is losing your job. Maybe it is repairing your car. Maybe it is finally turning down work that is destroying your life. That answer tells you what your savings are really buying. Before you leave, comment start below and check the pinned comment. I'll leave the free checklist there if you want a simple framework for calculating your emergency target and building your first real layer of financial breathing room. First $10,000 will probably not make your life look dramatically richer from the outside. But inside your financial life, something important changes. Fewer decisions are made because you have no choice. And sometimes that is where wealth truly begins. Not when you can afford more things, but when money finally gives you the freedom to say, I have options.